Good to have you with us, Michael. Where is the euro headed? Look at this big decline for the common currency over the weekend.
Well, good morning, Suzanne. Speaking to some of our chartists this morning, the targets they have in mind are just above 132 and then eventually 128. Now, they're not predicting that for today or tomorrow, but given that we've broken through that key support at 140.50 and it looks as if we're going to stay well below that, they are looking for lower levels again as the weaker euro gains momentum on the downside.
Okay, and why is that? Are they pricing in a default of Greece? Has already been factored into the currency markets?
That's certainly one of the concerns weighing on the market. There was a big shift in sentiment with the news from the ECB that it no longer held a tightening bias. A lot of investment flows were supported by that potentially higher interest rate environment. With confirmation that that's no longer the case, we have seen what I believe is investment flows out of Europe, both Europeans investing overseas and those previously invested in Europe returning their funds to their home countries. And the evidence for that is the trading that we've seen in the euro. Although it's been a sustained fall, it's occurred over 3.5 sessions, indicating this is not the hot money, this is not the trading money that's pushing the euro, but investors bailing out.
Yeah, well, you got a lot of problems over in Europe right now. It looks like it might be a banking crisis, considering Moody's looking to downgrade its rating on these French banks. Deutsche Bank fell and tumbled on Friday as well. What sort of turnout and playout are we expecting from Europe itself? Are we expecting more defaults? I mean, what is your firm expecting?
The big argument in Europe at the moment is what to do with Greece. It appears the markets are pricing a 90% probability of default now, almost inevitable. And it's what happens after that default that becomes most important. Does Greece get cut free and lead to the inevitable breakup of the EU? Or are its debts guaranteed? Does it remain in the fold? And does it have to offer up more fiscal sovereignty to the European Union? That latter course appears to be the one that Europe is favouring at the moment, although all ideas are on the board. We've had reiteration from the IMF and the ECB that there is no liquidity crisis in European banking circles. It does appear that it's fear around the banks that's driving the sell-off we've seen in their share prices rather than any actual exposures.